Hey everybody, Coburn Sheppick here from Limited Partners Club. I hope you're having a fantastic week. In today's video, we're going to be discussing commercial real estate investment strategies. So this is based on risk and reward profiles, not a specific asset class, but specific investment strategies as it relates to investing in commercial real estate. The topics that we're going to be covering are core plus, value add, and opportunistic. So we're going to dive into each of these strategies and sort of talk about the nuances of each. So starting with core, which is the best of the best type of asset class here. This is the lowest risk, and historically, core assets have produced between 7 and 11% returns historically. This data is just based on looking over the past decades of profiling these types of investments. So core investments are stabilized properties, turnkey, and majority of the returns are generated from the cash flow that property produces. So the majority of returns are based on cash flow more so than the appreciation. So some examples of core properties would be a commercial tenant. Think of a quality commercial tenant. Could be a national drugstore like a CVS or a Walgreens or a Starbucks, right? These are solid commercial tenants, typically on long-term leases, sometimes up to 30 years. And the lease terms are either triple net or double net. So triple net is taxes, insurance, maintenance, right? Or double net is two of those three. And so typically a commercial tenant, a strong commercial tenant, creditworthy commercial tenant will be paying either a triple net or a double net lease, which removes a lot of the risk away from the operator or the sponsor. So core investments, think of the best, most quality types of assets. It could be a commercial tenant like this, or it could be a Class A brand new apartment in a great location that's stabilized with creditworthy tenants. So this historically is low risk. There's no, when it's acquired, if it's already stabilized, when it's acquired, there's no deferred maintenance. There's no issues. It's turnkey, it's generating cash flow, which makes it the least amount of risk and potentially the least amount of upside. So core plus, so think of us moving down the spectrum here as far as turnkey, right? So next down the spectrum is core plus. And as we move down, the risk becomes greater. So core being at the lowest risk, core plus is now low to moderate risk, and historically has produced returns between 8 and 12%. So the performance can be improved in core plus properties through actually improving the property itself, improving the management, or improving the tenant profile. And there are higher rates of cash flow, and a higher portion of the returns are made through appreciation because of the improvements that we're making to the property or the management or the tenant profile. With core plus properties at acquisition, more cash flow, or throughout the holding period, more cash flow will need to be used for maintenance. These are older properties. That means more cash flow needs to go back into operating or back into the maintenance of these types of assets. An example of core plus would be an older, maybe 10-year-old multifamily property with a good track record still of occupancy, but could use some slight upgrades. So to put this into perspective, it might be old finishes, right, with the ability to add sort of makeup to the kitchens. It might be stainless steel appliances or new countertops, or instead of the classic wood finish cabinetry, it might be more modern and white and slick. And by doing these types of upgrades, we can achieve a premium on the rent or a premium on the tenant profile. Moving down the spectrum again, value add, which everybody loves value add. This is increasing our risk. So now we're at a moderate to higher risk. Our returns are justified based on that risk and have historically produced between 10 and 15% returns. So value add is typically underperforming at acquisition in terms of the occupancy, in terms of its maintenance, and in terms of the in-place management. So because of this underperformance, there is the potential, if we do X, Y, and Z, to actually boost the cash flow. Most of the returns through value add are cash flow, as well as a lot more ability to appreciate in value. With any heavy lifting, so now we're getting into a more heavy lifting project because it's not turnkey. This requires a great track record on the operator or the sponsor side, and really strategic planning in the execution of key events. And by key events, we mean what needs to happen, what good things need to happen in order to get this property to where it should be performing as it relates to comparable properties in that specific market. So for example, we might need to get the property, it might need some upgrades, and it needs releasing, it might need new tenants. So all those things would be key events, and those key events need to be executed in order for the property to perform at its potential. So for example, an underperforming vintage multifamily, this means old, right? It needs a complete makeover, and it might need, it will need improvements on the maintenance. It might have occupancy issues, and it could use stronger management. So value add is typically a complete makeover to an existing property on the actual physical property itself, or the maintenance, or it could be underperforming in an occupancy perspective. So lastly, moving down the spectrum is opportunistic, which is at the most risk as it relates to the strategies of investing in real estate. And so historically 12+% returns, and because we're at the most risk. And opportunistic, again, back to the key events, this is starting from ground zero. So opportunistic is typically either a ground up development or changing the use of a specific property, which is adaptive reuse, which we've talked about in past meetings. But the key events, there's more of them that need to go into play in order to bring the property to stabilized. So in both of these cases, a ground up development, adaptive reuse, we're talking entitlement, zoning, all construction, lease up, right? All this needs to be done in order to produce $1 of cash flow. And so these types this type of strategy is higher risk. It takes a longer period of time to produce cash flow, and it takes a longer period of time to see a return or to exit that property because of all the key events that need to occur. So these 4 strategies, just to jump to to conclude here, these 4 strategies are really, from the investor's perspective, are based on the specific risk and reward profile that you prefer as an investor, the time frame that you're willing to hold to have your cash tied up in that opportunity, and the market and asset preference, right? That people are biased towards what types of deals they want to be involved in. And the most important part as it relates to investing in one of these strategies is the strength of the operator or the sponsor involved. So to put that into perspective, a great stabilized or class core operator is not the best fit for doing a ground up development, and vice versa. So good deals can be hurt by bad operators. That's what it comes in a nutshell. So we are auditing our partners, auditing their track records based on market, based on asset type, based on strategy, core, opportunistic, etc. And these should be aligned to the opportunity that you're seeking. And lastly, we've talked about this. We always talk about this is the terms of the investment themselves. So there needs to be an alignment of interest between the operator, the sponsor group, and you as the investor, no matter what type of strategy you take as it relates to investing in commercial real estate. So I hope this gave you a good understanding today, high level of the different commercial real estate investment strategies, what the differences are when it comes to risk. This is what it all comes down to: risk and reward, and the ability to have stabilized versus having to be involved in the key events that need to occur to produce a larger return, and the risk that comes into that. So by having an alignment of interest as relates to the investment terms, by partnering with strong operators and sponsors, we can eliminate some of that risk off the table to capture better returns. That's the goal here. So I hope this helps. Well, I've got you here. I want to introduce you to Limited Partners Club. We are an exclusive members-only community for passive private investors, and we have started this community to create a network of like-minded individuals and families that want to tackle subjects around private equity, around commercial real estate, and really around wealth creation, capital preservation, and legacy. That's our topics. That's our mission to sort of discuss those topics with our members. So if you would like to join, I'd love to invite you in. It's completely free. We're planning on doing, we have this regular Zoom meeting. We plan on doing some private events. We do have an online community, so it's completely free to join. Our mission really is to create a very quality network, share about what's going on in the market, talk about these topics like we're talking about today, and ultimately do deals together. So if you'd like to join, or if you are already involved and would like to invite somebody, please go to limitedpartnersclub.com. That's limitedpartnersclub.com. My name is Coburn Sheppick. I'd love to connect with you. I'm mostly on LinkedIn, but I would love to connect with you, or we connect in the community. Thank you for your time today and attention, and we will see you next time. Cheers.